right, Selena. So let's just jump right into it. The market, it's already pricing a Maryland electricity rate spike at 64, right? But the cable consensus, still at 50. There's a huge gap here, no? Yeah, Amara, and it's so clear. Governor Wes Moore said it this morning in Baltimore. Reliability without affordability is a transfer payment. It's a wake-up call. His bipartisan coalition, they've put a massive $27 billion collar on the June 30th capacity auction. It's a huge political move. A $27 billion collar, wow. So they're anticipating serious costs the public narrative isn't getting. I mean, FERC's already ruled the PJM tariff unjust on co-located load, and capacity prices have jumped 1,000%. And still, the headlines call it a chip story. Exactly. Most coverage sees data center growth as AI scaling, but the actual contracts, they're reading it as the wall. The narrative prices the upside. The order book, it's pricing the bill. It's a totally different reality playing out. So, this wall instead of a chip story? That's a big deal. The contracts are pricing a constraint. And you mentioned FERC's ruling earlier. What exactly was that December 18th decision? It sounds foundational.
It absolutely is, Amara. On December 18th, FERC found the PJM tariff unjust and unreasonable under Section 206. That language is doctrinal. It's the lever the Commission pulls when an existing rate structure can no longer be defended. A rate is supposed to be a boundary, but they turned it into a variable. It's a total paradigm shift.
Wow. So the foundation became a parameter, and it just flew under the radar outside the trade press? That's incredible.
I know, right? And it's been in motion for a bit. The Commission specifically named co-located load, data centers wired directly behind the meter, saying the current treatment isn't just or reasonable. Compliance filings were due in January and February. The tariff is being rewritten in real time. That June 30th auction, it clears against a completely new rulebook, essentially.
So they're rewriting the rulebook, not just tweaking numbers, but adjusting what the numbers are for. The capacity market was supposed to spur new generation by high prices, right?
Precisely. And the load forecast it clears against, it's no longer what PJM thought it was modeling. PJM actually said this on May 6th. Data centers can be built much faster than generation can be built to serve them. The model's core assumption, it's broken. The pricing is now doing what the model wasn't designed to do. It's a fundamental disconnect.
That's wild. It brings me back to Governor Moore. He walks into that PJM meeting, May 12th, and doesn't lead with policy. He leads with a definition. Reliability without affordability is a transfer payment. And his audience is the people running the system making that transfer. That's quite the message. It really is. And he's not alone. This bipartisan governors coalition formed in January, before states were even overwhelmed. That's key. The political response is preemptive, not reactive. The coalition's reading the same data the contracts are. They're seeing the wall too, Amara. Okay, so if the contract is pricing 14 points above the narrative, and this coalition sees the same data, and FERC made its big move, then the wall is real. So what happens to the AI build-out plans, the ones financed assuming this wall wasn't coming?
That's where the crunch truly happens. The financing breaks at the developer level first. Existing independent power producers, Constellation, Vistra, they benefit. But new generation developers, they see a capacity revenue stream now constrained by a political collar. They can't price it forward with the certainty their financing needs. PJM called it out in May. Whipsawed policy creating financing gaps for needed generation. It's a real bind.
So the bottleneck is becoming self-reinforcing. The capacity market signal for new generation is being muffled by this collar. And the collar exists because the actual clearing price would be, politically unsurvivable. So no new generation gets built, demand keeps rising, and the system just stays trapped.
Exactly.
And 67 million ratepayers in 13 states sit downstream. Demand response, people cutting back when the grid's stressed, is now contracted capacity. PJM forecast it'll be cold on this summer during typical peak demand. The system's moved from emergency reserve to baseline reliance. That's not a market tweak, it's a structural shift, you know? Wow. And this is where the divergence stops being technical. The contract at 64 isn't pricing a tail risk, it's the median path. And that path includes a Maryland electricity bill increase greater than 5%. An individual ratepayer has no direct way to intervene, no rate case. The political channel, Governor Moore, the coalition, that's the only surface, which is why he's in Baltimore today, not Annapolis. Absolutely. And one more thing, transformer lead times. Maryland's Energy Administration reported that equipment to modernize substations is on a multi-year delivery window. Even with political will to build, the physical components just don't arrive in the AI build-out timeline. The contracts price this, but the narrative, not at all.
Okay, so this pattern, markets pricing constraints before the narrative names them, it's not just the grid, right? The mifepristone access contract is at 72, while cable calls it a toss-up. Alabama redistricting sat at 45, when the read was the court would let the map stand. The contracts, they're not intuition, they're reading which institutional levers are actually being pulled.
Precisely. 3 contracts, 3 divergences, 1 clear pattern. It's not the market is always right, but that it's pricing decisions by named officials on dated dockets. The narrative? It's pricing rhetorical positions. Different inputs? Totally different prices, Amara. The calendar knows. And in each case, the binding decision is on a calendar. May 11th for Alabama, resolved. Mifepristone's stay expires soon. PJM auction, June 30th. The dates are visible. The decisions are coming. The contracts are pricing them. The narrative isn't. So specifically, what should listeners watch for, especially after June 30th? Watch PJM's clearing price announcement first. It's quick. Then the Maryland contract in the 72-hour window. Above 70 means the collar held, but the underlying clearing tested the cap. Narrative was wrong. Towards 58 means PJM's long-term pathway is gaining traction. Capital priced the wall 14 points above the narrative on May 12th. The auction resolves which was leading, which was lagging. The answer, Amara, is already on the calendar. We're just, waiting for the clock.
Well, darlings, what a deep dive into the hidden currents of our energy future. Thank you so much for joining us today. Before we sign off, please, if you found this illuminating, show us some love. Like this video, drop a comment with your thoughts, share it with your network, and of course, subscribe to help us grow this vital conversation.
Indeed, Amara, the clarity you bring to these complex dynamics is invaluable. As we've discussed, the critical dates are upon us. The decisions made and the prices revealed post-June 30th will truly dictate the market's trajectory, impacting millions of ratepayers directly. It's a foundational moment for the PJM grid. And what a moment it will be. It truly feels like the narrative is catching up to a reality the contracts have whispered all along. A sensual dance between what we're told and what is. So much more than just numbers, isn't it, Elena? Absolutely. This isn't just about electricity prices, it's about the very structure of our energy future and the transparency of its costs. The calendar, as you noted, holds the answer. We're observing a system in real time reprioritizing its core assumptions under significant strain.